Hi, if you know, the minimum retirement age of an employee in Malaysia is at 60 years old. And why? It's because it suits with average life expectancy of 74.5 years according to the Statistic Department. And thanks to the improved healthcare services, 60 years old is actually now considered as a decent age for retirement. Yeah, 60 years old and still going strong. But here comes the question. As Malaysians, are we prepared for a comfortable retirement? Can our retirement fund make our retirement fund? Yes, it's possible. Just remember a few basic points I will share later that's going to help all of you. Looking at the retirement age, we are expected to live 15 to 20 years of post-retirement life, and we need to make sure that from now on we need plan and make sure we live comfortably after 60 years old. But the reality is, in Malaysia, a happy retirement for most Malaysians is still far from reality. Why? According to AKPK, more than 50% of Malaysians may not be financially ready for retirement. Why? Didn't we save money every month? Yes, we did, but most of us was saving less than 10% of our monthly salary. True or not? Tepuk dada, tanya selera. Hari ini rasa nak makan laksa. Besides that, out of 14 million members of the EPF, only 7 million members are actively contributing to EPF. According to EPF, in March 2018, almost half of the members aged 54 years old only have saving of 31,000 in their account. Most of them are non-active members. Shocking? If like this, don't talk about retire early at 50 years old. Even retired at 60 years old is a problem now. Why is this happening to most of the Malaysians? Are we not working hard enough? No, we are motivated to work hard so we can live a comfortable life today. But we rarely think about what will our life be when we getting older. No worries, got EPF and FD. I think I save out enough for my retirement. You think, but is it really enough? What are the mistakes we made when we try to save out and plan for our retirement? Number one, not having a goal or plan. Most of us are very passive when it comes to retirement planning. We solely depends on EPF and let it run automatically. And to be honest, this is a huge gamble. For your information, many retired Malaysians finish up their EPF savings within 5 years and do not have a backup plan. You must also bear in mind that the goal after retirement is to enjoy the same standard of living as your working years or better. Not having a plan will see you running into financial difficulties and possibly placing a heavy burden on your family members. There are also factors such as inflation and the rising cost of goods and healthcare to consider, which will increase your living expenses. Having a proper plan will help you achieve a worry-free retirement. Number two, not diversifying our savings. As mentioned, we rely too much on EPF, but we should realize that EPF should not be our only source of retirement funds. Despite growing at a rate about 4% to 6% a year, there are also other options with similar or better returns to consider. Take example like PRS. AIA PRS funds performance can be considered stable and good return with average at 4% to 8% in long term. Number three, withdrawing from your EPF account 2. While your account 1 is strictly off limits till retirement age, EPF has made it possible for you to make withdrawal from your account 2 under specific circumstances. You can make withdrawal for the down payment on a home, to repay a mortgage, for further education or unexpected medical bills. However, unless you are in a bind and are disciplined enough to replenish the funds when you're back on your feet, it may be wiser to leave that money in the account, especially if the funds are being used for a growing investment. Instead, looking into growing your EPF funds further, the EPF allows members to withdraw up to 20% of their account 1 for investment in EPF approved unit trust after the basic savings in account 1 has been set aside. Number 4, starting the saving habits late. Believe me, the sooner you start saving, the earlier you can retire. By starting the saving process early, you can enjoy the magical power of compound interest. Take example, you save 10,000 and your bank gives you 3% per year in interest. You will have 10,300 at the end of the year. The next year, you will begin to earn interest on 10,300, and at the end of the year, you will have 10,600 109. Now imagine you add 1,000 every month into the same account. At the end of 10 years, you will have amassed of 153,000 ringgit. Without compound interest, you will only have 130,000. This means that you earn 23,235 just from compound interest. It is advisable to start saving in your 20s so that you have more time to let compound interest do its work. Saving your money in the bank is not the only way you can let compound interest work for you. You can look at other investments such as saving plans for 10 years to 20 years and enjoy the dividend payout every 1 to 2 years, and invest in a moderate risk funds such as AIA balance funds if you are not a risk taker in investment. Number 5, allowing debt to pile out and finish up your bonus. Many of us believe that since we are contribute to EPF, got ourselves a house, a bit of saving, okay, we are safe. We can spend our annual bonus like there's no tomorrow. Enjoy dulu. I would suggest we look into another way around. In my opinion, instead of spending the bonuses immediately, look at how we can use it to settle our debts. For example, like car loans, credit card, mortgage. Then look into growing our saving or investment. Well, to be honest, it's no fun at all. Other do it, I play enjoy. Well, that's not true. I'm not asking you to put all into savings or paying debt. Set aside a portion to pamper yourself after minus up all your bills payment, debts, and savings or investment. You deserve it anyway. Just have to plan it wisely. Number 6, not putting healthcare costs into the account. Many of us take our health for granted and do not have a backup plan for illness. By the time we retire, medical costs will be far higher than they are today. We will have increasing needs for healthcare as we get older. But how about if we have to retire early due to illness? So it is important to consider a medical and income protection plan to cover hospital, outpatient, and other healthcare needs, not just during retirement, but also when critical illness like stroke or cancer happens. Plan your medical protection according to your needs. And of course, nowadays, medical cards in the market have coverage more than 1 million ringgit annual limits for claims and no lifetime limits. At the same time, plan for your income protection by looking into critical illness coverage with 5 times of your annual income. It is important to ensure that your retirement plan includes funds for a situation like this in order for us to avoid using up all our savings. That's all from me today. I hope this episode can help us to understand and give ideas on how we should plan our retirement fund by avoiding a certain mistake and make sure we will have enough retirement fund to live comfortably and happy when retirements come. Remember, retirement fund is for retire fund. Start your saving and investment today. If you're concerned about risk, take a look into insurance saving plans which comes with coverage and saving at the same time. Support you during the rainy days and still continues to help you prepare for your retirement funds. My name is Moses from The Insurance Guy. See you again.